Welcome. It's Goodrich Financial Advisory. My name is Michael. Today is Casual Wednesday, July 3rd, in preparation of the glorious American holiday, July 4th, Freedom Day, guns, munitions, explosives, and glorious colors in the sky. Today we're going to go over some financial charts from the Federal Reserve, the Fred website. Give a quick 30,000-foot overview for you to think about during this glorious holiday week, and to see what steps you can take to prepare and what's currently happening. So, first of all, core CPI PCE still above the Fed's target rate of 2%. They would like everything to go back under 2% for their trend before they even consider dropping rates. This is important because a lot of people, especially in commercial and some growth companies who are very levered, are anticipating the Fed cutting rates so that they can refinance, really. I mean, a lot of people are looking to refinance a lot of debt, whether you're in residential homes, whether you're commercial, whether you're an investor, private equity firm, uh, venture capital. A lot of funds that we used to be slushing around are not slushing around so much anymore so quickly. This is a chart of commercial and industrial loans. As you can see, we had a large refinance, and then everything's starting to putter off and go down. And you're going to notice a common theme across these charts: as debt stops growing and even modulates down slightly, we see recessions, right? This is going to be a very common theme across these charts. So right now, commercial loans, not in a great spot. We're going to go to the CPI that we just talked about. This is the sticky price, consumer price index. That's not a mouthful. Less food and energy. Food and energy, the part that most people care about, but this is what the Fed is actually looking at. This is actually what they're tracking. So this is what we're going to pay attention to. So right now it's currently still at 4.3. Peak 6.4. This is a historical chart that goes back to the 80s. So no, we did not have the inflation pain of the 80s. But most of the consumers and a lot of businesses are tapped out. And why? Well, if you look at a year over year, instead of this squiggly line where is it up, is it down, if you add all those price increases together, this is what the broad CPI, less food and energy in the US city average looks like, right? And so if you start all the way back here at 28.6 and you just add the inflation rate on it over and over and over again, this is what we're looking at today, which the same thing in, let's go back to 1990, would be $137. Today would be $318. So this is, even though we talk about inflation going down, unless it goes negative, it doesn't remove the price increase from the previous year. It just means it's growing slower. And as you can see, prices are still ridiculous. So this is the market's forward-looking rate to see what future expectations of inflation is going to be. As you can see, in the peak in 2022, we were about 3.57, and then towards the end now here we are at 2.26. So if the Fed cuts rates prematurely, this forward-looking inflation expectation will go up. And if that goes up, the 10-year yield will sell off, and that the 10-year yield is the benchmark in which all other rates are anchored. So you have the 30-year fix for the mortgage, 5-year floating commercial rate, industrial loans, business loans are all anchored on forward expectations, which is anchored to the 10-year treasury. So if we look even farther, here's your 10-year. It's basically the same, just a little bit more flat. And so this is your risk profile for the 10-year treasury, basically. Why is this important? Because this is the national debt. The national debt is getting out of hand. It's a little bit all over the place. As you can see, our government has a spending problem, but you as the business owner, why do you care? The more debt that this country takes on, the more it stunts growth. The more it stunts growth, the more you still have to try and grow and build small businesses to grow the GDP, or gross domestic product, faster than the debt acquisition, or you end up with more inflation that makes it even harder for your business to actually operate. So if we look at gross domestic product, this number that includes deficit spending needs to grow faster than the debt number. So as of right now, the debt number is 34.5 trillion. Gross domestic product is 28.2 trillion as of Q1 2024. But if we look at the deficit spending, so if you were to take this part that's under zero, this is the amount that the US government spends in excess of tax receipts every year. This GDP number takes in that deficit spending as a positive, not as a negative. So if the government decides that we're going to spend $1.6 trillion extra this year, that gets added into the GDP spend. It's a little bit more complicated than that, but that's the 30,000 broad stroke overview of how that works. And so if we didn't have this deficit spending, the economy would be in much worse shape than it already is. And I'm sure that some of you already have realized that the economy is not in a great spot. This is the unemployment rate going all the way back to before 1950. As you can see, during COVID, we had this astronomical spike, and then it cratered, and now we have labor hoarding, where I'm sure you as a business owner are terrified to let go of your qualified people, and you are trying to figure out a way to keep these qualified people on board and not have to deal with that painful hiring process again. But as we can see, the unemployment rate is starting to creep up, and we just hit 4%. It's nothing crazy. It's not like back here during 2012 or 2009. It's not like anything back here, but how stretched and how strained the economy is, this unemployment rate doesn't have to go very high to cause big ripple effects and issues inside of the economy. I did not realize that my head was in the way until just now. Job openings. So this goes on to the unemployment rate. So Jerome Powell was very worried about how ample, and he was using this instead of looking at the unemployment rate for justifying keeping rates high. But the amount of job openings per month versus the unemployment rate. So like we're starting to see a slowing in companies hiring. It's not a good sign. So people want to retain talent and they don't want to hire anybody else. And so companies are trying to avoid having individuals poached from them. And that brings us to the delinquency rate in business loans. It hasn't, I mean, we have an uptick, but it's nothing crazy yet. We don't see one of these. But as you can see, the gray shaded areas on all these charts are recessions. It doesn't take much until the recession hits, and then it just gets out of control. So this delinquency rate's not going to come all the way up to 2.5%, 3% before the recession starts. We maybe have another percent and a half room for a wiggle before this gets interesting very, very quickly. And then to justify my point earlier, talking about different sectors of the economy having issues unless you're directly tied into government spending, this is total business sales. And so as you can see, during recessions, they dip dramatically, and we had a dip, obviously, when they closed all the businesses. And then we had a very sharp recovery into July. And then now, when the government started printing stimmy checks and giving everything out, business sales went up and up and up. And now we're stalling. Ever since about June 2022, everything's been kind of chopping sideways. And we've been seeing a rolling recession, maybe too strong of a word, but rolling reduction in top line revenue across different industries. So like trucking and shipping went first. They went through about 18 months of just an absolute shit show. Leisure and hospitality is recently starting to rebound, but had a big issue after the spending high went over. It basically, if you're not in defensives, if you're a business that specializes in repairing, if you're a business that, the faucet's linking, the car breaks, you have to have it, you're going to be fine. But if you're in a discretionary business, things are going to be very, very difficult. And the reason I say all this and I get into this is depending on the sector and the business that you're in is what your strategy should be forward. Broad stroke, and this is not individualized advice because each business is completely different. But if you have a large leverage ratio, you have a lot of debt, especially short-term revolving credit debt, it's time to start thinking about terming some of that stuff out, hoarding cash, getting ready for a downturn in top line revenue, a downturn in sales. So things need to start getting real efficient real quickly. But with that, I will leave you guys until next time. Have a glorious 4th of July and a very blessed week.